All right, let's dive into a really fascinating story from the world of high-stakes tech. It's a story about how a company can do pretty much everything right and still not come out on top. This, right here, is the Nvidia paradox. So let me start by asking you a question that just seems to break all the rules. Imagine a company drops an amazing earnings report, just blockbuster numbers. The stock should shoot up, right? I mean, that's how it works. But what if it doesn't? What if it actually goes down? That's the puzzle we're going to solve today. To really get what happened with Nvidia, we first have to kind of set the scene. You got to understand the mood on Wall Street that day. This all went down on August 28th, 2025. And believe me, it was not just another Tuesday. The first clue about the market's mood? Gold. The price was ticking up, which is a classic signal that investors are feeling a little bit nervous. When things get shaky, they tend to flock to what they see as safe haven assets, like gold, looking for some stability. And at the very same time, you had oil prices kind of taking a hit. Now, cheaper oil might sound like a good thing for your wallet, but to the market, it can actually be a bit of a red flag. It often signals that traders are worried about a global economic slowdown, which means less demand for energy. And to top it all off, everybody was on edge, waiting for some huge economic data drops. We're talking everything from manufacturing numbers to how confident consumers were feeling. So you've got this atmosphere of real uncertainty. The stage was set. A jumpy, volatile market. And then, after the closing bell rang, came the main event. The moment everyone in the tech world was holding their breath for, Nvidia's earnings report. So, the big question, how did they do? Well, on the surface, they were absolutely fantastic. Just look at the revenue. They pulled in $46.7 billion. Wall Street was expecting $46.05 billion. That's not just a beat, that's a solid win. And check out the growth behind that number. A 56% jump in revenue compared to the same time last year. For a company this massive, that kind of growth is just staggering. And the good news just kept rolling in. Earnings per share, or EPS, another beat. They hit $1.05, which was better than expected and a huge leap from the year before. I mean, by any normal measure, this report was a total home run. So, revenue's up, earnings are crushing it, growth is through the roof. The stock must have gone to the moon, right? Well, this is where our story takes a really sharp and very unexpected turn. It's time to crack this paradox wide open. Why on earth did the market give what looked like incredible news a thumbs down? Here's the number that made everyone's jaw drop. In after-hours trading, right after the report came out, Nvidia's stock didn't soar. It fell. It dropped about 2.3%. This is the heart of the paradox. A straight-A report card, but the market failed it. Why? The whole answer boils down to this one key idea: priced for perfection. Think of it this way. Investors were so hyped about Nvidia that they had already baked all this good news, and then some, into the stock price before the numbers were even released. The expectations weren't just high, they were impossibly high. They were flawless. So, with that mindset, investors started digging, looking for any tiny crack in that perfect picture. And they found one. It was in the data center segment, the absolute engine of Nvidia's AI business. Now, they brought in an insane $41.1 billion, but the estimate was just a hair higher. It was a tiny miss, but in a market that's priced for perfection, even the tiniest miss feels like a giant disappointment. And if you looked under the hood, there was a little more to the story. You had geopolitical issues like U.S. export restrictions that were hitting chip sales to China, which is a huge market. You add that to the sky-high expectations we just talked about, and a general nervousness in the air about a potential AI bubble, and, well, you've got the perfect recipe for a negative reaction. So when you lay it all out, the paradox becomes crystal clear. On one side of the scale, you have all these huge wins. They beat on revenue, they beat on earnings, their gaming division did great. But on the other side, you have the worries, that tiny data center miss, the China headwinds, and that one big overarching problem. The stock was already priced for utter perfection. And in that moment, the worries just weighed a little bit more than the wins. Okay, so let's zoom out for a second. What's the bigger lesson here? What does this all mean, beyond just one company on one particular day? This quote just nails it, doesn't it? When expectations are already in the stratosphere, a report that's only spectacular isn't good enough. It has to be flawless, perfect, down to the very last detail. Otherwise, the market just sees it as a letdown. And all of this really points to the key takeaway, especially in these super hot sectors like AI. A company like Nvidia isn't just being judged against how it did last quarter or last year. It's being judged against the perfect, flawless, explosive future that the market has already dreamed up. And in a race like that, anything less than perfection can feel like you're losing. And that leaves us with one last big question to chew on. As technology like AI keeps moving at lightning speed, and investor expectations just keep getting higher and higher, have we actually reached a point where just being great simply isn't good enough anymore?